to PhillipCapital Expert Talk. My name is Sayles from Phillip Security Research. Today we have with us Matthew Eagen, Vice President and Portfolio Managers of Loomis, Sayles and Company. Matt is the manager of the flagship fixed income fund, and he manages institution and mutual fund portfolio. He has with him 22 years of experience and joined Loomis since 1997. Matt is also a CFA and Chartered Financial Analysis holder. Welcome, Matt. Thank you for having a time to attend this interview with us. We will get to the first question. Looking at the current economic backdrop and an impending Fed rate hikes, how do you position your fund in terms of duration and credits?
Right, so you know the fund has a lot of flexibility. We're not like a traditional core fund that's going to be very sensitive to interest rates. But in terms of our interest rate positioning, we don't think we're really getting paid to take term structure risk in the developed world treasury markets. So when you take the US, for example, our treasury duration now is much lower than the benchmark. We're taking a lot less treasury risk than we have historically. A multi-sector income fund is a full year or so below the benchmark. So we're not exposed to rising interest rates, and the correlation of our fund in terms of its performance will be quite low relative to treasury returns, and that's a good thing. Where we see value in the market is in the corporate bond area right now, particularly the lower quality. That we couldn't say that last year. There wasn't as much value, but that's changed. Prices have gone down, mainly due to a growth scare in the global economy. And so a value proposition is open up there. So we have a good allocation into the spreads, both investment grade but high yield as well, and sprinkling some into the other places like convertible bonds and such.
Secondly, the fund has generated positive returns since 2009. However, based on the August 2015 fact sheet, year-to-date return was negative. Please share with us what has or has not worked for the fund's strategy.
So I think it's important to keep in mind the strategy and how it will perform over time. We are long-term investors. We look at protecting principal over the full cycle. So really, to invest in our fund, you should have an investment horizon of 3 to 5 years or longer, and we think we'll deliver very good returns. But in the shorter period of time, you can have underperformance. Over a year's time frame would be unusual. They're typically the cadence of the fund is you'll typically have some drawdown in parts of the credit cycle or the cycle, and then you'll do well for a period of time thereafter. What's really important is to be a good selector of items, so be a good bond picker. And the idea is to avoid permanent principal loss. So we're willing to take some variability in our returns as long as we're not permanently having a permanent reduction in capital. So through the cycle, we'll protect capital and we'll actually add a lot of value. What's driven the fund recently, again, will always be exposed to risk through the cycle. So we'll be riskier than the traditional core fund. We tilt long risk. We think you get paid to do that through the cycle as long as you control permanent drawdowns. That's where the research comes in. So we pay attention to item selection, and we want to buy securities at a price that we think will deliver performance over a longer period of time. So recently we've seen, as I mentioned, a sell-off in the credit markets, a sell-off in the global markets based on a growth scare, and we've had exposure there. The valuations have dropped. We've gotten some negative value associated with those areas. We think it's temporary, and we think longer term the item selection will drive our performance.
Thirdly, what fixed income sector do you currently favor, and why?
Well, I think in the context of where we are in the cycle, I like corporate bonds. Our fund is tilted towards the credit sector right now. When you look at where we are in the cycle for credit, it's really bifurcated. And that's why it's a little bit confusing to investors right now. But the commodity sectors are in a downturn. And that's because they're linked to China growth. And China fixed asset investment has come down and decelerated, and that's spelled difficulty for commodity prices and hence commodity sectors. I think there's good value in that space, particularly in the energy markets. I think oil related corporate bonds actually look quite attractive for people who can discern value in that space, like I think we can. For the non-commodity space, I think there's decent value in the context of late expansion. Though the non-commodity space in high yield, in the corporate market in general, is hitched to the U.S. economy, which is doing very well. It's running at about a 3% underlying growth rate. So fundamentals look pretty stable. Default rates will be low, but you're getting paid quite a decent yield to take on that risk in the market right now. So we think that looks pretty good on a going forward basis.
How do you feel about the U.S. fiscal policy currently?
It's important to understand that this is going to be a recurring problem for the U.S. because we face a structural fiscal deficit, and that's brought about by demographics. So we have baby boomers that are retiring, and the entitlement programs that we have in our country are going to take up more and more of the budget. So we'll run significant deficits that will, from here, get worse. In addition to that, we have pretty significant demands on our defense spending as well, given the state of affairs in the world. So when you take those two, you see structural deficits. So rather than being counter-cyclical, you see fiscal spending when the economy's weak, you're just going to see a structural deficit. And that's going to be, I don't think that the U.S. is not going to default on its debt, right? That is not an issue because, of course, we're the reserve currency, and we can always print more money to pay that debt back, as long as people are willing to lend money to us in our own currency, and I don't think that's going to change. So it's a vibrant economy, and it's still a great place. It's a safe place to invest. But I think over time what it means is that there's probably a structural shift in the market where we're moving from a secular declining rate environment. We're transitioning to an environment where rates are likely to start rising on a secular basis because of these fiscal pressures, and really the way you deal with that is you debase your debt over time and rates go up. So I think that's what we have coming forward, and these pressures will continue to rear their head from time to time.
Finally, given the continuous strengthening of the US dollar, is there still value outside of US denominated bonds?
Yeah, the answer is yes. There is value in non-dollar assets. So what's driving the dollar, right? So the dollar is strong, and it's sort of a little bit counterintuitive to what I just talked about in terms of the state of the economic affairs in the United States, the fiscal deficit. I do think, as strategically speaking, so thinking long term, all reserve currencies, major reserve currencies, are likely to appreciate over time. Why? Because of structural deficits. The U.S. is not the only one that faces that issue, and demographics, and growth. So when you add all that together, those currencies, the yen and euro, are likely, along with the dollar, to decline over time to other currencies that can hold up better, or even commodities, which should become more expensive in dollar terms over the long run. So the dollar has that going for its long term, but shorter term, the intermediate side, I think the dollar can be strong relative to the other major reserves. So it wouldn't be surprising to me to see dollar be strong versus the euro, which is printing money through quantitative easing, demographic issues, growth issues, and the yen, same problems there, same issues going on. So where's their value? I think in the EM space, and you got to be careful where you're picking in this market, but there are certain EM currencies that I think offer good value, like the Mexican peso, I think is a good example of a country that's made a lot of structural reforms, and the currency's kind of bombed out right now, and yields are attractive. Commodity currencies, so staying in the developed world, the Aussie dollar, the New Zealand dollar, the Canadian dollar, now those have been trouble spots for us too and others. But I think now what's priced into the market is basically a hard landing in China. EM currencies and commodity currencies are going to be driven by China growth and commodities. I think if you believe like what we do is that China is sort of bottoming here, is kind of stabilizing, it's righting itself a bit. I think that spells better times ahead for some of the commodity currencies and yield currencies. But again, you got to be careful at where you're picking your spots there.
Once again, thank you, Matthew, for sharing your insights with us here today. For more information, log on to our website at www.eunittrust.com.sg or visit any of our Phillips Security branch. Thank you.